Welcome to the YouTube Phil's Gang channel. Now, we had the numbers come out, as you know, terrible. Our GDP negative for the first quarter, and I just want to give you an up to date where this market stands, because how can this market keep making new highs every year for the last 6 years, and yet the revenues are contracting? Makes no sense. So I'm going to explain this to you and why the correction is going to happen. Very important. So first of all, we've been having the stock market rallying 30% a year. There's your stock market. Okay. And it's been going up 30% a year. Now, and they're telling everybody, hey, things are swell, things are really good. But there's a divergence that's been going on that nobody's talking about. If you take the S&P, take the 40 top companies, the S&P, they're showing their earnings. We'll put the earnings in white because it's earnings that makes the stock market go up. Here's the earnings. Okay, the earnings right here, earnings, have been going up to 9.1%. And it's the earnings that drive the stock market up. Okay? So these two work together. But there's a problem. There's no growth. The economy is growing at, here's the economy. We'll put this color in the economy right here. We use this color. The economy is growing. We'll call this, okay, we'll call the economy. Okay, there's the economy. That's growing at the 2% GDP. It's only growing at 2%. Actually 1.9, but I'll round it off. 2%. So there's your growth, the economy. Well, if our economy's not growing, that means people don't have savings. That means people don't have good jobs, because the economy should be growing, okay, at 7%. But at 2%, the value of right now, the economy is growing at 2%, but we have the stock market value over here at 21%. That's a PE of 21. So you got a PE of 21, which doesn't make sense because you're only growing 2%. So your stock values are at a PE of 21 when this is only going up 2%. But what makes it even worse is the revenue side. As these earnings are going up, the revenues are going down. So your revenues are contracting. Okay? These are revenues. These are sales, top line sales. So let's think about this for a moment. So how could earnings be going up? It makes no sense, because what after all, what are earnings? Okay, that's, if you don't have earnings, you can't have, if you don't have sales, you have no earnings, right? Because earnings come from sales. These earnings come from revenues. All right, there's our revenue and sales, same thing. So our revenue and our sales are contracting by 8%, negative. So our sales and revenues are going down, but our earnings are going up. If you're not selling anything, how could your profits be going up? Your earnings are going up. Does that make sense? And because of this, you're going up 9.1%. They're saying that the stock market's worth 21. So they're saying the stock market up here is worth a PE. Okay, we'll get up here, PE of 21. So revenues are going down 8%, earnings are going up 9.1%, so this, which is pushing the stock market up. And they're saying, so that means our stock market is now worth 21, but our GDP is only 2. So we're only growing 2% a year. So how does this make sense? So if you're going to have a GDP, if you're going to have a stock market where you got a PE ratio of 21, you need a GDP, you need growth to justify that, okay, of 7%. So you need a growth of 7% to justify a 21 value. But what do we have? We have a GDP, okay, growth of 2%. Are you kidding me? So we got a GDP growth of 2%. So that means if we got a GDP growth of 2%, then this should be 21. If this is 21, then this should be, let's say, 16. Okay, so this actually, using this 2%, should be 16. That's what this should be. 2% equals 16, 7% equals 21. But we're at 21 with 2%. We got revenues going down 8%, while earnings are going up 9.1. And earnings is what pushes stock market up. So we got a real problem here. We got a lot of. So how can you do that? It's called engineering, financial engineering. Okay, financial engineering, and what it is accounting. It's financial engineering or accounting tricks. Okay, and the accounting trick is quantitative easing. Okay, QE. So what they do is they do all these tricks, and the first trick they do is they take and they put in to get these earnings up. Okay, they do stock buybacks. So if you do a stock buyback, and what they've been doing is stock buybacks, and the stock buybacks pushes earnings up. Because with a stock buyback, you are buying your shares back. Let's say you had 1 million shares, and you cut that down to 500,000 shares, okay, 500,000 shares. That means the earnings that you have, you're spreading over fewer shares. So that means your earnings keep going up. So it's been the stock buybacks of 1.8 trillion that has been shooting the earnings up without sales. So if you don't have sales, you create a trick. You go in and QE will provide 1.8 million to companies to buy their own shares back. When you buy your own shares back, you have half the amount of shares, so your earnings shoot up to 9.1. If they didn't do this, these 9.1 right here, that would be down. This earnings, if we didn't do this QE, we'd be back to 2010 levels, and these earnings would be probably somewhere around, maybe around, I don't know, 6%, something like that. But we'd be back really down to about 2010 level. So here's this. So now what does this all mean? It means that they're going to need QE to keep this going, another QE. So bottom line, the stock market has been going up, and we've been going up 30% a year or 120%. We drove the stock market up 120%. What drives the stock market up? Earnings. And earnings of 9.1% is what they're saying. But we don't have 9.1%. Our earnings are really, if you take the earnings, I would say it'd be probably about 2.3% is what they boosted the earnings by, 2.3%. So with all the stock buybacks. So you got all of these earnings from stock buybacks while all the revenues have been going down. So there you have it. And you got an economy that's growing at 2% because of Obamacare. And so this PE ratio up here of 21, we need 16. So what's going to happen? Well, here's what's happened right now. So they've done this. The stock market, as I say, has been going up, but now we've stopped going up because QE has stopped in 2012, except for the stock buyback. So now we're stuck. We can't break out. We've been trying, but we can't break out. They've been doing everything to try to break this out, and they just can't do it. So how are they going to break this guy out? Well, what they got to do is come in with QE and take the 10-year Treasury and drop it down, that 10-year Treasury rate at 2.4% and drop it down to 1.4%. And they to get that way there, the Saudis and everybody, instead of putting money into the Treasury to loan to them, they will buy stocks. So we got this big, all this is financial engineering because of Obamacare. So last time, we've had companies showing the earnings going up 9.1%, but earnings come from revenues, but revenues are going down. So they've been able to push it up 9.1% artificially by doing stock buybacks of 1.8 trillion, and that way there you have less shares. That means the earnings they do have, okay, spread over fewer shares, which pumps up your earnings by 2.5% better than they really should be. So your earnings pushes up the stock market. So without sales, they came up with an idea. Sales are retracting because of Obamacare. People don't have savings. They don't have good jobs. There's no investment in businesses. There's no investment in housing. So the economy is going back. So the economy is at 2%, struggling because there's no revenue. So you got to have revenues to push the economy. So there's no revenue. So all this 9.1% is 1.8 trillion in stock buybacks. And that earnings has pushed the stock market up. Now we're so high, we're up here with a PE ratio of 21 in here when it should be 17. So how's it going to drop back down to 17? Well, they'll drop it back on their own, okay, because the institutions are not going to be putting more money in. There's kind of a buyer strike. So from 21 to 17 is what you need to have a GDP. A GDP, again, a GDP of 2%. 2% should have a stock market value of 17. We're at 21. To be at 21, you got to have a GDP of 7%. So you got to either grow the economy from 2 to 7% to justify the 21. They'll never be able to do that with Obamacare because it destroys jobs. So that means we're going to contract from 21 down to 17 because we're not going to be able to ever get above this 2%. That is going to be a 20% stock market correction. So that means the stock market is going to correct right here 20%. It's going to correct down 20%. Okay? Because of, guess what? Because again, everything's been fake. It's all been fake. All these earnings have been fake. So we're not getting revenues. So they're kicking up the earnings by doing stock buybacks, which have been kicking up the stock market, which gives it a value of 21, which is really only 17. So our GDP is not enough, a growth of 2% to subsidize 21. So what's going to happen is they can either grow the economy from 2 to 7, which they're not going to be able to do. Obamacare it won't do it with Obamacare. So this will contract, which means you'll get a 20% pullback. Now, how can they stop that from happening? Doing QE4. If they bring in QE4, they can stop, for now, a contraction, okay, of 20% or a correction. Because QE4, what they'll do to keep this market up here is they'll take the 10-year Treasury that's at 2.4 right here, and they're going to cut that. They'll buy the Federal Reserve will print money, and they'll cut this down. They'll buy their own treasuries to 1.4. Well, that means the Chinese and the Saudis, who love buying treasuries at 2.4, which they're loaning money to the government, okay, when they see this down to 1.4, they'll put their money into the stock market, pushing this back up. They'll push that back up to make sure it doesn't happen. So they'll push that back up. By doing QE, they can push this 20% drop back up, or not even, or actually won't let it start. So that's why you need QE. So that's where we are. If there's no QE, you're going to have a correction, okay? 20%. See you on the charts.